Every January, the Social Security Administration makes adjustments to the program. It's routine. It happens like clockwork. But 2026 brings 6 specific changes that will affect your benefits, your taxes, and potentially your retirement strategy. Let me walk through each one clearly. If you're interested in this topic, hit the like button, subscribe, and type "interested" in the comments. And I will give you a heart. Change 1. The 2.8% COLA increase. Every year, the Social Security Administration announces the cost of living adjustment, commonly known as COLA. This isn't arbitrary. It's calculated using a specific formula tied to the Consumer Price Index for urban wage earners and clerical workers, or CPIW for short. For 2026, Social Security and Supplemental Security income recipients will see a 2.8% increase in their monthly benefits. That's up from the 2.5% adjustment we saw in 2025, but it's significantly lower than the 8.7% increase in 2023 or the 5.9% increase in 2022. The COLA reflects inflation trends from the third quarter of the previous year. When inflation runs hot, COLA tends to be higher. When inflation cools, as it has been doing recently, the adjustment moderates. This is the system working exactly as Congress designed it back in 1975 when automatic annual adjustments became law. Let me break down what this actually means in dollars and cents. The Social Security Administration estimates that the average retirement benefit will increase by approximately $56 per month. That takes the typical retiree's check from about $1,927 in December 2025 to $1,983 starting with the January 2026 payment. If you're receiving the average Social Security benefit right now, that 2.8% COLA translates to an additional $672 per year. Before taxes. Before Medicare premiums. Before anything else gets deducted. Now, I understand that $56 a month isn't going to dramatically change anyone's lifestyle. It's not a windfall. It won't fund a European vacation or a new car. But when you're living on a fixed income, every dollar matters. That extra $56 might cover a week's worth of groceries. It might pay for prescription medications. It might help with rising utility costs. The reality is that COLA serves a specific purpose. To help Social Security benefits maintain their purchasing power as the cost of goods and services increases. It's not designed to improve your standard of living. It's designed to prevent your standard of living from eroding due to inflation. Here's something important to understand about how COLA is calculated. The Social Security Administration looks at the CPIW data from the third quarter of the current year and compares it to the third quarter of the previous year. If there's an increase, beneficiaries get a COLA. If there's no increase, there's no COLA that year. This actually happened in 2010, 2011, and 2016. In those years, beneficiaries received zero COLA because the CPIW showed no increase or even a slight decrease from the prior year. The 2.8% increase for 2026 reflects the fact that while inflation has cooled considerably from its 2022 peaks, prices are still rising. They're just rising more slowly than they were. Gasoline costs less than it did 2 years ago. Grocery prices have stabilized somewhat. But housing costs, medical care, and many services continue to climb. One criticism of the COLA formula is that it uses the CPIW, which tracks spending patterns of urban wage earners and clerical workers. These are typically younger working-age people. Critics argue that seniors spend money differently than younger workers, particularly when it comes to healthcare costs, which tend to consume a larger portion of a retiree's budget. There have been proposals over the years to switch to the CPIE, which specifically tracks spending by Americans 62 and older. This index typically shows higher inflation for seniors, which would result in larger COLA increases. But Congress has not made this change, and it's not on the immediate horizon. Another factor that often gets overlooked: COLA is applied to your benefit amount before any deductions. If you have Medicare Part B premiums deducted from your Social Security check, those premiums are rising too. If you have federal taxes withheld, those continue. If you're repaying a Social Security overpayment, that continues. So while your gross benefit increases by 2.8%, your net benefit, the actual money deposited in your account, might increase by less. There's also a provision in Medicare law called the Hold Harmless Rule. This protects most Social Security beneficiaries from having their net Social Security payment reduced due to Medicare Part B premium increases. If the premium increase would exceed your COLA increase, the Hold Harmless provision limits your Part B premiums so your Social Security check doesn't actually decrease. However, this protection doesn't apply to everyone. High-income beneficiaries who pay income-related monthly adjustment amounts for Medicare Part B aren't protected. New Medicare enrollees aren't protected. People who don't have Part B premiums deducted from Social Security aren't protected. The bottom line with the 2.8% COLA for 2026 is this. It's a modest increase that will help your Social Security benefits keep pace with inflation, but it's not going to feel like a substantial raise, especially after Medicare premiums and other deductions are factored in. It's maintenance, not improvement. And that's exactly what COLA was designed to do. Change 2, higher taxable wage base. The Social Security taxable wage base is one of those technical terms that sounds complicated but is actually straightforward once you understand it. This is the maximum amount of earnings subject to Social Security tax in any given year. And for 2026, that ceiling is moving up significantly. In 2025, the taxable wage base was $176,100. For 2026, it's jumping to $184,500. That's an increase of $8,400, which represents one of the larger year-over-year increases we've seen in recent history. Here's how this works in practice. Social Security is funded primarily through payroll taxes. If you're an employee, you pay 6.2% of your wages into Social Security. Your employer matches that with another 6.2%, bringing the total to 12.4%. If you're self-employed, you pay the full 12.4% yourself because you're both the employee and the employer. But that 6.2% doesn't apply to every dollar you earn. It only applies to wages up to the annual cap. In 2026, that cap is $184,500. Let me show you what this means with actual numbers. If you earn $50,000 in 2026, you'll pay 6.2% of that entire amount in Social Security tax. That's $3,100 for the year. This change doesn't affect you at all because you're earning well below the cap. If you earn $100,000 in 2026, you'll pay 6.2% of that entire amount, which equals $6,200 for the year. Again, this change doesn't touch you because you're still below the threshold. But if you earn $200,000 in 2026, you only pay Social Security tax on the first $184,500. That's $11,439 in Social Security tax for the year. Everything you earn above $184,500, in this case $15,500, is not subject to Social Security tax. Now here's where the 2026 increase matters. Because the cap went up by $8,400, high earners will pay Social Security tax on an additional $8,400 of income that wasn't taxed in 2025. Do the calculation. 6.2% of $8,400 equals $520.80 in additional Social Security tax for employees who earn above the new cap. For self-employed individuals, it's double that amount because they pay both the employee and employer portions. They'll pay an additional $1,041.60 in Social Security tax in 2026 compared to 2025. Your employer is affected too. They're paying 6.2% on that additional $8,400, which is another $520.80 per high-earning employee. For companies with many highly compensated workers, this represents a real increase in payroll tax expenses. Now here's something interesting that many people don't realize. Once you hit that $184,500 cap during the year, Social Security tax stops being withheld from your paycheck for the remainder of the year. Let's say you earn exactly $200,000 annually, paid bi-weekly over 26 pay periods. That's roughly $7,692 per paycheck. You'll have 6.2% withheld for Social Security from each check, which is about $477. But here's what happens. By late November or early December, you'll have earned $184,500 for the year. At that point, your payroll system stops withholding Social Security tax. Suddenly, you're taking home an extra 6.2% on each remaining paycheck. It's not a bonus. It's not a raise. It's simply that you've maxed out your Social Security contribution for the year, and the law doesn't allow any additional withholding beyond the cap. This creates a noticeable bump in take-home pay for those final paychecks of the year, which is why some high earners refer to November and December as their 6.2% months. The taxable wage base increases annually based on changes in the National Average Wage Index. When wages across the economy rise, the Social Security wage base rises correspondingly. This ensures that the system continues to capture a consistent portion of the nation's wages as the economy grows. There's an important policy debate embedded in this cap. Currently, about 94% of all wages earned in the United States fall below the Social Security taxable wage base. That means roughly 6% of all wages escape Social Security taxation entirely. Some policymakers argue this cap should be eliminated or significantly raised to strengthen Social Security's finances. Others argue the cap exists for a reason. Social Security benefits are also capped, and there's a relationship between what you pay in and what you receive in benefits. Removing the wage cap while maintaining the benefit cap would fundamentally alter that relationship. For now, the cap remains in place and continues to adjust upward each year. If you're a W-2 employee earning above $184,500, you'll see this change reflected in your pay stub starting January 2026. If you're self-employed, you'll account for it when you make your quarterly estimated tax payments or when you file your annual return. One final note: this wage base applies only to Social Security tax, not Medicare tax. Medicare tax is 1.45% for employees, 2.9% for self-employed, and it applies to all wages with no cap. High earners also pay an additional 0.9% Medicare tax on wages above $200,000 for individuals or $250,000 for married couples filing jointly. The $8,400 increase in the Social Security wage base for 2026 represents a straightforward tax increase for high earners. There's no avoiding it if you earn above the threshold. But if you earn below $184,500, your Social Security tax burden remains exactly the same as it was before. Change 3. The $6,000 senior deduction. This deduction took effect in 2025 and continues into 2026. But there's widespread confusion about how it actually works. First, let's clear up the biggest misconception. This deduction is not tied to when you start collecting Social Security. It's tied to age. You must be 65 or older to claim it. Starting Social Security at 62 does not qualify you. You have to wait until you turn 65. Second, understand the difference between a deduction and a credit. A credit reduces your tax bill dollar for dollar. A deduction reduces the amount of income subject to tax. A $6,000 deduction is worth $720 if you're in the 12% tax bracket. That's $6,000 multiplied by 12%. It's real savings, but it's not a $6,000 check. Third, this deduction stacks on top of your existing deductions. You still get the standard deduction. You still get the existing additional standard deduction for taxpayers 65 and older. And now you add this $6,000 senior deduction on top. Let me show you what that looks like in practice. Say you're 67 years old and single. In 2026, your standard deduction is $16,100. The additional standard deduction for being over 65 is $2,050. Add the new $6,000 senior deduction. Your total deductions come to $24,150. Now assume your adjusted gross income from pension, 401k withdrawals, and taxable Social Security is $60,000. Subtract $24,150 from $60,000. Your taxable income drops to $35,850. That income is taxed progressively. The first $12,400 is taxed at 10%, which equals $1,240. The remaining $23,450 is taxed at 12%, which equals $2,814. Add those together, and you owe $4,054 in federal income tax for the year. That works out to approximately $338 per month. Without that $6,000 senior deduction, you'd be paying $720 more annually, assuming you're in the 12% bracket. If your income pushes you into a higher bracket, the deduction saves you even more. But there's a phase-out. If you're single and your income exceeds $75,000, the deduction begins to phase out. It disappears completely once your income reaches $175,000. The phase-out range is $100,000. That's the difference between $75,000 and $175,000. You need that number to calculate how much of the deduction you lose. Here's an example. You're single, over 65, with a modified adjusted gross income of $100,000. You're $25,000 into the phase-out range. Divide $25,000 by $100,000. That gives you 0.25 or 25%. Apply that 25% reduction to the $6,000 deduction. 25% of $6,000 is $1,500. Your deduction shrinks to $4,500. You still benefit, just not to the full extent. Change 4. The Social Security earnings test. This matters if you're working while collecting benefits before reaching full retirement age. In 2026, if you're under full retirement age for the entire year, you can earn up to $24,480 without affecting your benefits. That's up from $23,400 in 2025. Earn more than that limit, and Social Security withholds $1 in benefits for every $2 you earn above the threshold. Say you're 64, collecting benefits and working part-time earning $30,000 annually. You're $5,520 over the limit. Social Security will withhold $2,760 from your benefits for the year. But understand this clearly, that money is not permanently lost. When you reach full retirement age, Social Security recalculates your benefit. They give you credit for those withheld months. Your monthly benefit increases to account for the months you didn't receive payments. It's not ideal to have benefits reduced while you're working. But it's not gone forever either. If you're reaching full retirement age in 2026, different rules apply. In the months before you hit full retirement age, you can earn up to $65,160 without penalty. That's up from $62,160 in 2025. Above that limit, Social Security withholds $1 for every $3 you earn over the threshold. Notice that's a more favorable ratio than the earlier rule. Once you reach full retirement age, the earnings test disappears completely. You can earn as much as you want without any reduction in benefits. No limit. No withholding. Change 5. Credits needed to qualify. This primarily affects younger workers, but it's important to understand how the system works. To qualify for Social Security retirement benefits, you need 40 credits over your lifetime. In 2026, you earn 1 credit for every $1,890 in covered earnings, up to a maximum of 4 credits per year. That's $80 more than the 2025 level of $1,810 per credit. To max out your 4 credits in 2026, you need to earn at least $7,560 in covered wages for the year. Most people accumulate 40 credits easily over a normal working career. But if you have significant gaps in your work history, or if you work jobs that didn't report earnings to Social Security, this threshold matters. Check your Social Security statement regularly. Make sure your earnings are being recorded correctly. Errors happen, and it's easier to fix them sooner rather than decades later. Change 6. Medicare Part B premium increase. Medicare Part B premiums are rising to $185 per month in 2026. That's an 11.6% increase from $165.90 in 2025. Most people have Medicare premiums deducted directly from their Social Security checks. So what happens to that COLA increase I mentioned earlier? A significant portion gets absorbed by higher Medicare costs. You might receive an extra $56 monthly from the COLA adjustment. But you're also paying roughly $19 more for Medicare Part B. Suddenly, that raise doesn't feel quite as substantial. This is a pattern that repeats itself year after year. Social Security benefits increase. Medicare premiums increase. The net gain to beneficiaries is smaller than the headline number suggests. If you're currently in the Medicare annual enrollment period, which runs from October 15th to December 7th, now is the time to review your coverage. Maybe you want to switch to a less expensive plan. Maybe your health situation has changed and you need different coverage. Maybe your prescription drug costs have increased. Maybe you're dissatisfied with your current plan's network. Whatever you choose during this enrollment period takes effect January 1st, 2026. Don't let the window close without reviewing your options. Why this matters. Social Security isn't exciting. But for most retirees, it represents a substantial portion of retirement income. Understanding how the program works matters. These 6 changes might seem minor individually, but they compound. The COLA gives you a modest boost in monthly income. The $6,000 senior deduction if you're 65 or older and under the income phase-out reduces your tax burden. The earnings test affects people who want to work while collecting benefits. The credit requirements keep pace with wage growth. And Medicare premiums continue their steady climb. It's all connected. Take the time to understand where you stand. Run the numbers based on your specific situation. If it feels too complicated, find someone qualified to help you work through it. This is your money. Your retirement. You worked decades to earn these benefits. Don't leave money on the table because you didn't understand the rules. The Social Security system has its complexities, but it's not incomprehensible. It just requires attention. Stay informed. Know what's changing. Adjust your planning accordingly. If this information affects you or someone in your family, share it. These changes touch millions of people, and most won't hear about them until they see a different number on their monthly statement. Subscribe if you want to stay updated on Social Security and retirement planning changes that actually matter to your financial security. The rules change every year. Staying informed is how you protect what you've earned.